Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. Australia is one big mine. That's the words of my next guest, Aaron Lynch of OptionsXpress. But what happens when that mine's biggest client, in this instance China, starts to show signs of a decent slowdown? Well, here's what he had to say. Aaron Lynch, thank you so much for taking the time to chat with Dukascopy TV. A pleasure to see you.
It's great to see you again, Natalie.
Okay, now we're talking that Chinese yuan depreciation and its outlook for the commodities market. Now, we've discussed a China slowdown quite a lot, really, in the last few months regarding the commodities market. As the key importer of everything, how much does this really change the playing field?
Well, look, we're really now starting to see a whole repositioning of, many years ago you would have remembered the term commodity super cycle was thrown about. And so we are in that very, very large wave structure of how commodities are moving. And, we've seen many, many years of multiple, very, very high levels of growth. And now we're rebalancing. And I guess probably the theme that I'd pull out to look at where we are at the moment is really the whole intervention by the Chinese government recently in the equity market moves, the Yuan's devaluation. Here they were moving towards a place where they were, really looking to establish themselves as a prime, player in the international markets. But they've sort of stepped back a little bit in terms of, that change in posture and trying to become a big part of it. So going back to some of those sort of more protectionist ways in terms of, wanting to, boost their domestic exports and things like that. So the cycle is of a concern because we are at a place where, and like we see in every commodities boom that's ever been in history, is that everybody's finally caught up in terms of the production side. So all the new mines, all the new production facilities are here, they're available, and they're absolutely looking to pump out as much as they can against a sliding story of demand. And so therefore we are now looking to that scene where, like we saw earlier in the year with iron ore, I expect to see players leave the market. You've got obviously the OPEC players, they're looking for market share. They're in a place in terms of oil prices where the price is secondary, the actual percentage of the pie is what they're playing for. So I see that in many of the commodity space. China's also trying to bring on their own domestic markets as well. So it's really that perfect storm. But it's no different to what we've seen historically. This is nothing new. It's just the 2015 version.
Now, the Aussie dollar had managed to steady itself as the yuan also stabilised. However, we've seen it bullied downwards by the US Fed meeting minutes that we're anticipating, and also that expectation of that September rate hike. Clearly, the Aussie dollar has more room to play downwards. What does this shape and impact really for domestic exporters?
Well, look, obviously the path of least resistance is down for the Aussie dollar, and I agree with you. That's the likely direction. Unfortunately, we've failed to evolve over the last decade of the commodity super cycle. We are still just a big mine here in Australia where we dig things out of and send them overseas and buy them back as finished products. So as much as we'd like to think people view our currency differently, it really is. We're a commodity-based currency. So as our market continues, or the dollar continues to slide, you would hope that those domestic producers have a smart hedging play in place. And being the big players, I'm sure they would. It's really those smaller guys, though, that can't either get traction or don't see the value in hedging. They're the ones that are obviously going to get gobbled up by an Australian dollar decline. And as we just discussed, they're obviously in the pecking order. They're the low-hanging fruit that's going to, fall from the tree in terms of, will they be here in 12 to 18 months. So we really will see, I guess, some consolidation of assets. I'm sure there'll be buyouts. There'll be, mergers where companies can't, continue to move on. But in terms of that Aussie dollar heading lower, it really is now a case of having a very, very good hedging strategy or perish in potentially the future movements that we're likely to see.
No, very much so. Now, in terms of our actual commodity products, we're looking copper looking pretty negative at the moment. Yep. Gold, an item we've spoken about previously, and I know you're not a big gold bug, but that's actually looking a little bit more to the upside of the back of this.
Look, it has had some tepid, improvement, and you would expect, given the volatility that we've seen and the activity we've seen in terms of all the intervention in China, the Greek situation, you would expect to have seen probably a little bit more of a rally in terms of those precious metals markets. But look, copper looks very, very weak. I'm looking at production numbers out in 16 and 17 in terms of the numbers, and that's probably, if we can maintain demand where it is, that's probably when that elasticity will start to come in a lot tighter, and hopefully that will hold a bit of a floor there. But there's been a couple of rallies. There was a rally out of January this year in terms of copper pricing, and that looked quite strong from a technical perspective. It was all the places where it was meant to be, but that basically fell away very quickly. So looking at the gold to copper ratio, you would expect, as copper continues to devalue, that gold should benefit from that. But I think gold has to have a number of other factors coming in. I know you spoke with my colleague Ben about the Fed Reserve and the FOMC. I'm still cautious about whether or not they will go with a rate rise. I think they've got to. I think it absolutely has to happen. But whether or not, I still see somewhere that they'll find a way not to, because they have in so many other cases. But time will tell. There will be a rate rise, and obviously that'll start to impact with the dollar as well. And that's really where I guess the second wave of concern comes for commodities. Is you start out with a oversupply, reduction in demand, and then you start seeing a shift in the base of currency in the US dollar, and that's just the second wave that just drags your commodity prices lower. So we'll see with bated breath what they do over the coming weeks. But in terms of gold prices, yeah, look, certainly there's a bit of a floor underneath there now. But in terms of whether it becomes the shiny precious asset that it was a couple of years ago, where everybody had to have as much of it, I'm still yet to be sold on that idea.
You mentioned there the US, and we're seeing alongside this devaluation story, we've also got renewed slides in oil prices. Interestingly, almost entirely separate from the China story, really. Walk us through sort of the drivers that we're seeing there, and also, is this a long-term play, do you think?
Look, as I said, OPEC's playing for market share, so they'll keep pumping. You've got obviously the Iran deal. You've got commodities just really setting themselves up for that period of oversupply and continuation, and who can last the longest. China's looking to transition to, they were looking to transition to a service-based economy more so than a consumption economy. The signals we've received recently kind of a little bit mixed in that regard, but I think China's a lot softer than what the numbers suggest, and I think what we're seeing now is as much backpedaling without necessarily startling the horses in terms of what they're trying to do in China to drive growth and demand. Will that be enough to pick up the elasticity in what we're seeing, particularly in crude prices? I'm bullish on commodities. I have been all year, and look, I still in that camp to a certain point, but I must admit I've become a lot more neutral in recent times. One of the things I'm watching is natural gas and the interplay with crude oil. There's a lot of big speculative shorts in the natural gas market, and if that turns around and they have to cover those shorts, we might get a little rally in natural gas, and I'm thinking that could be one of the aspects that drags oil with it. But we certainly could have, oil's technically placed right now at a really strong place in terms of technicals. If we don't get a bounce out of here, then that test tells me that the remainder of this year looks certainly weaker.
Aaron, I will leave you and Ben LeBrun to battle it out on your Fed expectation. Thank you so much for your time today.
Absolutely. Thanks, Natalie.
Always a pleasure to catch up with Aaron Lynch of OptionsXpress. That's all we've got time for right now, but I will be back with plenty more exclusive interviews for you right here from the heart of the APAC region. For now, though, it's goodbye.